If you pull $500,000 of surplus out the usual way, you could lose roughly half to tax right away, leaving only about $250,000 to actually invest. In this video, we'll look at why that happens and what owners are really trying to avoid. One way to do this is to borrow personally. Invest those funds in a non-registered portfolio, and then use salary or a bonus paid by the company to cover the loan interest. Because the borrowed money is generally being used to earn income from business or property, that interest is usually deductible, which can help offset the personal income created by taking that salary or bonus. For the deduction to hold up, the CRA expects three things. You need a legal obligation to pay interest. The interest has to be paid or payable in that year, and the rate has to be reasonable. Just as important, the borrowed money needs a current income-earning purpose, like a non-registered investment, and the interest is usually claimed on line 22100 of your personal return. First, you take out an investment loan personally, so you're accessing capital without first triggering a large taxable dividend from the corporation. Next, you put that lump sum into non-registered investments, because the borrowed money needs to be tied to an income-earning use. Then the corporation pays you salary or a bonus equal to the interest cost, which gives you cash flow to service the loan instead of draining the surplus all at once. The company is still getting cash to you each year, but now that payment is covering interest, and the interest deduction can go a long way toward neutralizing the annual tax hit. So instead of leaving surplus trapped and idle inside the corporation, you can have more of that money working in the portfolio where it's meant to grow. If you borrow $250,000 at 5% and the portfolio earns 6% a year, the account grows to $447,712 over 10 years. Once the loan is paid back, the illustrated after-tax value comes out to $160,641. That estimate assumes only 25% of the fund return is taxable each year, and that those income allocations are taxed at 25%. Segregated fund contracts can give you market growth potential, but they also layer in guarantees around income, death, and maturity, which makes the planning conversation much broader than returns alone. They may also bring potential creditor protection and estate planning advantages. So for some business owners, they're not just an investment choice, they're a structuring tool. On published terms, these investment loans may offer up to 100% financing, no margin call when the balance is $1 million or less, and interest-only payments to keep cash flow lighter. Once the loan goes over $1 million, a margin call is triggered at 85% and has to be restored to 75%. And if you're in Quebec, the deductibility rules may not work the same way. The company should pay you salary or a bonus, not pay the lender directly, and it generally shouldn't guarantee the loan or pledge corporate assets as security if you want to keep the structure clean. If CRA approves a T1213 request, your withholding at source can be reduced, but the request needs solid support behind it and, in most cases, you'll file it again each year. If you'd like to explore whether this retained earnings strategy makes sense for your corporation, reach out to TVH Financial. You can email financial@tvhgroup.ca or visit tvhfinancial.ca to start the conversation.